Hello, everyone, and welcome to this episode of 22 Minutes with Jason and Stefan. I am Jason Bates, and I'm going to bring you the lender side of things for today's episode. He is Stefan Cotton. He's going to bring us the realtor side of things for today's show. There, you get the applause. Golf clap, golf clap.
Yes.
We hope to not only entertain you, but also bring you valuable information that you can actually use when you're looking to buy, sell, refinance property anywhere in the country, actually. And I'm going to save that for tomorrow, right? Tomorrow's episode.
Yes.
What happened to us yesterday? What happened yesterday? I'll save that for tomorrow's episode on the Reflection Friday kind of thing.
Yeah.
But yeah, if you're anywhere in the country and you have a real estate question or a real estate need, if you will, please reach out to us. We'd love to help you out. This show is We're based out of Phoenix, Arizona, and we do this 8:30 a.m. Monday through Friday out of Phoenix. But if you're somewhere else in the country, hey, these questions kind of are applicable no matter where you live, really.
Right.
Right? They're not
for the U.S. for sure.
geographically sensitive, I guess.
Right.
So
how we do things in America.
one nation. All right.
America.
Yeah. So, hey, we always do a tweet quote of the day. Oh, I forgot to say, if you're new to the show, hey, this show is about real estate. So please sure to share with your friends and family or anybody that you know who may be looking to buy, sell, refinance, or invest in property. Share with them. If you want the actual notifications that we're going live, go head over to our Facebook page at 22 Mins and like the page there for us, and you'll be notified when we go live. That would be pretty cool, right? We got a new like yesterday, which is fantastic.
Yes.
All right, let's get to today's tweet quote of the day, and then we'll get into some questions here because these questions I think are super important. So let's do it. All right, positive thinking. We got to be positive, Stefan.
Yeah, it's true.
Get out of negative town, right? Positive thinking will let you do everything better than negative thinking. Amen, Zig Ziglar.
Yes.
Can I get an amen?
Let me finish the quote. Then negative thinking will.
Oh.
There's one more line. That's
Did
all
I
right.
not say that?
Oh no, you didn't read the last bottom part, but you said you stopped the negative, but it's all good. Gives me something to do.
Oh, all right. All right. That's
But yeah.
keep me
positive
centered,
thinking.
man. Keep me centered.
I'll tell. Can I kind of reflect here? We had a team meeting on Wednesday.
Yeah.
And one of the things we do with our agents is anybody that calls our for sale signs,
Yeah.
phone number that they call all of the agents on my team, their phone rings. The first one to get the phone to answer gets that lead. And there was a guy in there that was like, "What? That's awesome!" And then there was another one that just kind of didn't say much. But the one that said, "What? That's awesome," has a better attitude. And I'm
Yeah.
pretty sure he's going to answer that phone.
Yeah. Yeah. It's all about positive thinking. We need more positivity in this world, too.
Right.
There's so much negative on the news, man. On the news.
Yes.
Hey, speaking of which, too, I saw a post yesterday, and I don't have it here for the show, but I saw a post by a local realtor who did a Zillow thing, and it's kind of negative, I guess. So Zillow, as we know, Zestimate's not very accurate, right? Totally way off base. Well, the Zestimate was like 420,000 or low 400s as far as the Zestimate goes. They just sold it for 523,000. So it was
Yeah.
off by over $100,000.
It's I had that one on the MLS, and I thought I should have taken a photo of it, but the listing agent actually quoted or took a picture. One of their real estate photos was the screenshot of the Zestimate. Look, Zillow says it's worth 180. So we're going 5,000 below what Zillow says.
Oh man, I thought that was kind of like, wow, that is a big difference. $100,000. That's almost a quarter, really, in value
Right.
to what they actually sold it for. So I thought that was kind of like, wow, it's quite the endorsement there. Yeah,
5%, really.
yeah, pretty bad. Okay, so, and I don't know if I have the show overlay here, but not the overlay, but the Throwback Thursday
Yeah,
question thing.
let's
I
do it.
don't have it. So we'll just
No
kind of
problem.
roll with it as we got it
I'll do
here.
it for you. Throwback Thursday.
There it is.
Imagine if you will. The logo. Yeah, we have a really good one for those that are new.
Hey, so this week I've had a couple different first-time home buyers call me, and
Good.
what was surprising to me was the lack of questions from them. They're like, "Hey, we don't know. This is our situation. We'd like to buy, but we don't know where to begin," kind of thing. Which is really the whole purpose of this show, right? Is
Yeah.
to help inform people.
Start from spot.
Yeah. And so it kind of struck me a little bit. So I want to kind of go over the conversation that I had with them. So first of all, I'd ask them, what their goals are and that sort of thing. Then I would present to them two different options, at least to them,
Sure.
which really primarily, and within these options, there are other options, of course, but FHA versus conventional, and the differences between the two financing options. Typically, I had a discussion with one of my coworkers about 3 or 4 years ago. FHA is really good for people who've had economic events. We mentioned on, I think it was Monday or whatever, the boomerang buyers and things like that coming out.
Yep.
FHA is a really good option for them because the waiting period on an economic event, such as a bankruptcy, short sale, foreclosure, is much shorter than on a conventional loan, Fannie Mae, Freddie Mac backed loan, which is 7 years on that, on a foreclosure anyway.
Yep.
But outside of that, the actual true financing, if you can qualify, and the standards aren't that high really for conventional financing. In fact, they've loosened those up. We've talked about that 50% debt
Yep.
ratio, getting more in line with FHA. If you qualify for a conventional loan, that's a better long-term loan than an FHA loan. And
Right.
the reason for that is because, or one of the big reasons for that, is the mortgage insurance. You know, before the meltdown, debacle, or whatever, 2008, just about everybody I talked to did not want to pay mortgage insurance. That's where this 80/20, loans came into play,
Or 80/10 or something.
or
Yeah.
80/10/10, or yeah, whatever. So they want to avoid this mortgage insurance like the plague. Now, I don't get that question as much. How do I avoid a mortgage insurance? I don't want to pay mortgage insurance. It seems to be more acceptable to pay mortgage insurance now, because really it's just about your only option. But
It is
there
what it
are
is. Yeah.
options to avoid it. There are options to avoid it. I want to preface that. Um,
Go in the
but
military and get a VA. No.
no, there are other ways actually.
I know.
Yeah.
Cash. That's the other way.
No, actually, you
Oh,
can buy out the mortgage insurance. You can
yeah.
do split edge on mortgage insurance. There are options within mortgage insurance to lower that or even avoid it completely and still
So
keep a Fannie Mae loan.
I'm not familiar with the split edge. What is the split edge?
So split edge premiums mean that you pay a point up front or three-quarters of a point or half a point or, some kind of premium up front. Generally like half, three-quarters, point and a quarter, point and a half, I think is how they break it down.
Okay.
And then that lowers your monthly premium.
Okay.
Now, this is really good for individuals who are right at that threshold on the debt to income ratio. Okay.
Right.
And some people say, well, I'll just put more money down. Well, when you take your loan amount and put an extra point down, that payment is not going to be impacted that significantly. Where you can have a greater impact on the mortgage insurance by paying a point to reduce the actual monthly premium that you would pay.
Yeah.
Okay. And for these reasons, this is why conventional is a little bit better. That reason there, but I think the bigger reason is because you don't have to refinance your loan to drop off the mortgage insurance. So once you have the 20% equity, or I think it's like 3 years or such.
78% it goes away.
Yeah, it goes away.
You can get it quicker if you get equity in the house as the price has been going up. But yeah.
Yeah, the burden of proof is on you as a consumer, and then the mortgage insurance drops off. Now, the advantage there is that you keep today's rates without having to refinance, and
Yeah.
you don't have the costs or the burden of the refinance.
Right.
So you're not tapping into your equity or sapping some of your equity to do a refinance. Most people, when they refinance, they roll the closing costs into the loan. Well, that takes some equity to do that.
Yep.
And then you're susceptible to whatever the market conditions are 3 years
Yeah,
from now,
maybe.
4 years from now.
Yeah, the interest rate might be higher. I don't think it's going to be lower.
Right. It's going to be higher, and that may offset the savings that you're trying to accomplish with that. So on an FHA loan, when you're putting 3.5% down, then that mortgage insurance is for the life of that loan until you either pay it off or refinance it. Or refinance is paying it off, but selling the house or whatever. So for that reason, it's not as favorable long-term solution. And so going over these things with the consumer or with these buyers, they had no idea. It's kind of like, whoa, okay, which is great because that's why I'm here to help them and explain the differences between the two. I think a lot of times in our industry, a lot of loan officers will just say, hey, okay, first-time home buyer, automatic FHA. Well, conventional financing, if your credit score is good enough, you can actually put 3% down, which is less than FHA, and the mortgage insurance can be lower than FHA.
I find historically, and correct me if I'm wrong, that's what this show's about, but the interest rate on FHA, the interest rate part is a little bit lower than the interest rate part of the conventional.
Yes, that's true. That's true. And the reason behind that is because it's a government-insured loan. Government-insured loan. That's a critical component to FHA, where conventional is privately insured, PMI. So where FHA is MI, mortgage insurance. And so investors look at a government-insured loan as more stable. In 2008, Goldman Sachs and some of these companies, too big to fail, deemed too big to fail. Well, they had large stakes in these mortgage insurance companies. And if they failed, mortgage insurance companies failed. And then all of a sudden we have all these conventional loans that are uninsured out there, and if they foreclose, banks then have to, it's a trickle-down effect. And so they were deemed too big to fail, where the government's not necessarily deemed too big to fail. If the government fails, we're all in trouble kind of thing. And so investors like that security blanket as an insured loan from the government.
So it's amazing, right? I mean, we take this for granted that we know the different programs out there. Mm-hmm. But that's why we do the shows, to make sure that the world knows about these different programs out there. Mm-hmm. So your new buyers, let's just call whichever one, what other stuff do you think that they didn't know that we should probably tell the world?
Well, I think they're not familiar with terms and so within conventional, within FHA, there's ARMs, there's fixed rate, there's different terms that you can have, that sort of thing. They really were just clueless. They just knew that they wanted to buy a house, which is kind of interesting to me. Like, they want to buy a house, but then didn't really know how to go about doing it, which is fine. Again, not trying to put them down or anything like that, but
well, they didn't know. Yeah, they don't know what they don't.
Yeah, they didn't know, and that's fine. But I guess I take it a step back, say, okay, well, why do you want to buy a house? I kind of look at why do you want to buy a house? What's the motivation for buying a house? And I'm seeing a little bit of a shift go on. 3 years ago, we talk about millennials. A lot of millennials weren't committed to doing and buying houses, right? They weren't even committed to living in one spot for any length of period of time.
Right. They'll for jobs and stuff. Yeah.
Yeah. I'm starting to see that shift a little bit, I think. And as a result, they're wanting to buy a house, but they don't know quite where to start to buy a house. They don't know the area of town. They don't know. I mean, you can probably speak to this. A house is an investment. Their need may only be, like, I have a first-time home buyer. He wants to buy a $100,000 house, which is going to be a challenge here in Phoenix, right? But I think buyers should look at the future, not just today. But if you don't need a 3-bedroom home, doesn't mean you shouldn't exclude looking at a 3-bedroom home, because that home's going to be more attractive to sell in the future.
Yeah, right. I have a 2-bedroom, 1-bath home for $110 hitting the market in about a week.
Oh, you do?
Yeah.
This would be perfect probably for this gentleman. Where's it located?
Buckeye.
Buckeye?
Yes. That's my the way I pronounce it is Buckeye. Yeah, Buckeye.
All right. Well, I'll let him know
for
sure. I think he wanted to be kind of central Phoenix and North Phoenix, but
North Phoenix, good luck.
Yeah, even Central Phoenix could be a little bit of a challenge there.
South of the 10.
Yeah, that could be a challenge. So I guess first time home buyers, don't settle. I think I had a tweet quote of the day for that. Don't settle. Ask
Yeah.
questions. Ask any question whatsoever to your lender. If your lender's not doing a good enough job explaining, have them give you options.
So
You know,
really quick, you brought two terms analogies. The ARM. I know an ARM to be like a 5 year, 10 year interest only payment, right? Or is that not necessarily?
no, and interest onlys aren't really available right now. There may be companies out there that offer interest onlys, but there's 3 year, 5 year, 7 year, 10 year arms. Those are the
And
most common. There
what do
are
they do?
1 year arms too, actually. There are.
What's the benefit for an ARM versus a 30 year?
The arm, the advantage there is if you know that you're going to live in the house for a short period of time, say 3 years or less, then a
Yeah.
3 or 5 year arm might be a little more attractive because the interest rate is going to be slightly lower. You as a consumer are taking on some of the risk when you're looking at an arm. And so as you taking on the risk of the market that the interest rate could go up, well, banks reward that by giving you a little bit lower interest rate.
Okay.
So those are really good for investors and on jumbos. Jumbo people in the jumbo market really like the arms. Yeah.
Okay. So first time home buyer, it's better to be safe than sorry. Especially if you're not savvy in this stuff. I would think if you're not doing it as an investment, then stay away from the ARMs because you might get in trouble if their interest
Yeah.
rates go up.
Well, the other thing too, and I'm glad you brought this up because the one first time home buyer asked me, you know, well, I asked him. I said, "What are your long term goals with the property?" He's like, "Well, I really don't know. I don't." I said, "Well, here's a little stat for you. The average life expectancy of a mortgage loan, just a mortgage loan, is between 4 and 6 years throughout the United States, and people either refinance or they sell that property within that period of time. So they may refinance out, to take cash out to improve the property, paying for
Right.
college, whatever. So the life expectancy of a loan is that. So sometimes if you think that you're going to, fit that category where you're buying a fixer upper and you may need to pull some equity out to do so, then to fix it up later on down the road, well, then maybe an arm might be a little more attractive. It's
Right.
it's really hard right now because the interest rates are historically very, very good. So it's hard to pass that up, right?
Right.
But as interest
Lock it
rates
in.
go up, we'll start to see more arms and more people gravitating toward arms, I think a little bit.
And then
But
you also said something else. You said arms, and then you said something else with that. That was another word that they weren't familiar with. Um, and I can't remember it off the top of my head now. I should have wrote it down. But I wanted to address it because you're saying you have these lingos, these terminologies. I mean, even mortgage insurance, really, people don't know about unless they know about it.
yeah,
Um, I just want to make sure that all these questions that they had or words that we're throwing out there that we're just assuming, like, do people even understand what Freddie and Fannie are?
yeah. So Fannie, Freddie Mac are kind of the pinnacle of underwriting in the mortgage world. So they're kind of at the point, if you will. They are actually, I think they still are, run by the government because they took bailout money. I think we just did if I remember correctly, we did an article on that where Fannie's even asking for additional funds and so on and so forth. So they partook in the TARP money, I guess, bailout stuff. So we, the people, actually own Fannie and Freddie, I guess, in a roundabout way.
Right.
They haven't gone on their own, which I think there's some political backlash on that now. I think there's some politicians who are saying, "Look, enough is enough. Get it together and become profitable." There was talk several years ago of the two merging together.
Right.
That hasn't
Maybe
happened
just a few
yet.
months ago. I mean, we talked about that, I
Yeah.
think, just halfway
Yeah.
through this year.
So, I don't get this question very often, but I've even wondered myself, what is the difference, right, between Fannie and Freddie? I mean, if they're
Right.
so doggone close to one another, what is the difference? Well, there are certain aspects of lending. Lending is nothing more than risk. And I had this discussion with the first time homebuyers too about credit scores. Credit scores are an interpretation of risk, period. That's all they are. And that risk varies dependent upon the collateral that you're applying for, whether it be a home, a car, credit card, furniture, whatever.
Yeah.
That interpretation of risk and lending you or extending you credit is an investment from the bank to you. So if they're going to make an investment in you that you're going to pay them back on a timely fashion, they want to know the risk assessment. And that's what that credit score is essentially done. The credit score that we get is based on filters that we put in place to create that credit score based on risk. When you go to Credit Karma, any of these other kind of consumer credit reporting deals, they're unfiltered. No filters associated with that credit score. So that credit score is always, 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 always going to be higher than what I'm going to pull because it's unfiltered. Okay, so don't say, well, I got a 700 credit score, and then I pull it and I got a 650.
Right.
That's because of the filters. So it's a good gauge, but it's not an absolute, when it comes to your credit score. So Fannie, Freddie, getting back to that question, there are some different variances within interpretation of risk that Freddie will do where Fannie won't. Fannie likes to see a lot of assets. They don't necessarily need assets to get an approval, but on the marginal kind of deals, Fannie Mae likes to see assets. Freddie Mac isn't so asset heavy. No, like liquid assets like money in the bank, reserves after you close, that sort of thing. So reserves are money that you would have left over to show that you'd have access to money in case you were to lose your job, that you can make a mortgage payment for 3 months, 6 months, whatever the case may be. That can be a 401k, that can be stocks, that can be a life insurance policy that has a cash value. Those are all considered liquid assets, not collectibles, not gold or that sort of stuff. I got a bunch
of comic books, like with Wolverine. No,
the original Superman comic book is not considered.
Not going to help with the down payment or the approval.
No. Okay, so, but there are differences there, and having a good experienced loan officer, I've had many situations where I've not gotten the approval through Fannie Mae and then switched it to Freddie Mac and gotten the approval. There is no price difference between the two. They are priced essentially the same. I've seen some lenders who have some different variations in pricing, but for me, they're priced exactly the same. So you're not sacrificing price to go with one over the other,
right,
as far as that goes. Just takes experience, an experienced loan officer to differentiate. There's some loan officers out there who don't even have access to Freddie Mac, surprisingly enough. I know.
That's not helping the client. I guess that's the number one question you asked. If you're a buyer, say, do you do Freddie? I don't know. I would think that you'd want more opportunity. But
yeah.
Maybe they have a program.
Yeah. Do you have all aspects of lending at your disposal, kind of thing? Well, that pretty much wraps it up. I think we kind of covered a lot there. Hopefully we didn't jump around too much there. Right?
I thought it was good. I thought you answered a lot of my questions.
All right, good.
I just want to make sure that the questions, the stuff you were saying was actually kind of worded to where everyone can get them, but I think it's good.
You helped me keep it down to earth?
I love the choice in shirt color today. It's not like we planned it. But
yeah, you like that?
Who wore it better?
Yeah. Who wore it better?
I'm wearing blue. Right. Always wear it better. No.
All right, man. Well, I appreciate that. Hey, that's going to do it for today's show. We're out of time. We thank you for taking time out of your day to listen to what us two white shirt guys had to say. We really do appreciate that. Again, if you know any friends or family who are looking to buy, sell, refinance, or invest in property, we want to be their team of choice. So please have them reach out to us. You can follow us on Twitter. Our Twitter handles are above there. You saw our numbers on the show as well. So please reach out to us. Reach out to the show. Comment on the show. We'd love to hear your comments and feedback on the show as well. So with that, everyone, tomorrow is Reflection Friday and Feature Friday. You got a property for us, right?
I got 4 houses hitting the market soon. None of them are on yet. So let's just go over the Cromford. Because next week, we're going to be slaughtered with houses.
Okay. All right. So tomorrow we'll go over some of the numbers. We'll dive into some of the numbers. I think let's hit Scottsdale tomorrow. Let's hit the Scottsdale numbers tomorrow. And then we'll reflect on the week that was. So until then, everyone, have a great day, and we'll see you tomorrow. Take care.